Hello, this is John Kicklighter, Global Head of Content for StoneX, here to discuss market conditions into next week and the top event risks that global investors will likely be focusing on for market movement. Now, in terms of the general market conditions that we are facing going forward, we are definitely seeing a drop back in the volatility that we had experienced the week before. Now, if you recall, the week previous, we were actually seeing a swell in uncertainty and volatility with the combination of the reapplication of delayed tariffs, as well as a little bit of an economic shock through data like the revisions on U.S. non-farm payrolls in the previous month's reading. And that nice combination was enough to get measures like the VIX to jump and a little bit of volatility from key market assets and coordination across these different market types. When you have that kind of impact in terms of abrupt or steep market movement, and it's fairly coordinated or correlated across otherwise unrelated assets, that's usually an indication that risk trends are starting to take hold, particularly risk aversion. Now, that risk aversion slowly mitigated through this past week. And that means that we need another catalyst because these markets are getting back into their comfort zone, being so close to record highs. That's going to be something that we need to see and monitor throughout this week. It's always an inertia consideration. It's harder to get us to shift from our norms than it is to simply feed into them. Now, another market condition that I watch is the concentration in risk trends. Now, you do have a concentration, which I've been talking about from week to week, into specific speculative appealing assets in regional buckets. So if you look at something like the NASDAQ 100 relative to the Dow Jones Industrial Average, that's the tech-heavy index with a really strong concentration in large market cap stocks versus the Dow, which is the blue chip measure, which is a little bit more indicative of, let's say, stoic measures like economic activity. That ratio has pushed to a new record high this past week. So there's a deep concentration into market cap, people chasing the faster or stronger performing benchmarks. That being said, we see a little bit of a diversification away some of the more traditional appealing assets, traditional meaning the past 3 or 4 years, and that is a move out of the concentration in U.S. equities. So if you look at a ratio like the S&P 500 versus a rest of world ETF like the VEU, that's actually significantly off its record highs, and it is certainly still wavering from week to week. So we want to watch that because it can say, yes, there's risk on, but the markets are going to be much more selective about what they're going to use to express it. Another important market condition that we need to be keeping tabs on. Now, one big condition that I'll be watching through this coming week in terms of event risk in the week itself, you're going to have a lot less concentrated scheduled event risk. So you're not going to have global macro catalysts that can stand alone and be the high probability charge for the entirety of risk trends. So you're not going to have like a key FOMC rate decision. However, we do have quite a bit of event risk. It's a little bit more stretched out. And the fact that we aren't really concentrating on a particularly market-moving theme means that it's going to be a little bit more difficult to turn what volatility we do get from the scheduled releases into consistent momentum that can turn into a broad market move. That doesn't mean it's impossible. Certainly everything's possible, but it's going to be a little bit of a higher lift to do so. Now, that being said, what themes should we be watching? I think one that's taking more shape now is the pressure that the White House, or specifically Donald Trump, is putting on a number of considerations across data, across trade relations, and across economic perception. It's really the shaping of the U.S. narrative that I think is most interesting. And we have pressure in terms of replacing a Fed board member just this past week, an early retirement. Obviously, the ongoing discussion about who's going to replace Powell. He's very interested in that. We had the replacement of the Bureau of Labor Statistics head, which is he did not like the quality of the data that was released in non-farm payrolls, thinking that that big revision was a sign that there was some kind of intent behind it. So that's going to be another important consideration of how it's shaping expectations and whether we can actually trust the data. This actually has a quality kind of like what happens in China. The global community, investment community, does not necessarily take the Chinese data at face value. And what does it do for the data itself? It reduces its market moving potential. We don't really see a whole lot of really abrupt volatility from Chinese data come through the woodwork. And there is generally a question as to its veracity. That could happen to the US if these trends continue. Obviously, we're still a long way off from that, but it's something to consider as we look at something like the CPI, which is due this week. Now, another theme that I'll be watching is the relative monetary policy consideration. Obviously, we're talking about the Fed, the Bank of England, who cut rates last week or this past week. We have consideration of the Bank of Japan. Is it going to hike rates in its next meeting? All this kind of conversation is ongoing. But I do think that we're going to start to see a little bit more interest in what is the collective monetary policy of the major central banks around the world, reflecting on the expectation for economic health. And what can it do in the short term to boost stimulus or the speculative appetite that we usually get from an easier monetary policy? There's a balance there. It gives a short-term boost when they cut rates, but it also reflects that there's a need to cut those rates. So there's an economic problem or a financial problem. And one last theme that I'll be looking for overall is the tariffs and geopolitical headlines. The tariff headlines, obviously we have a big one between the US and China this week, but it's also the geopolitical. Obviously there's flare-ups around the world. One that I'll look at in something we haven't really considered really in the past couple of years, what if there is a announcement of progress and ceasefire between Russia and Ukraine? Is there latent risk appetite that can be unlocked through that? I think there is, even though we consider it to be a low probability because the war continues. But if it does happen, I think the market's lack of expectation for it mean it's not priced, and then it can be a charge to the upside, where very few really impressive charges exist. Now, in terms of scheduled event risk, Monday's empty. There's event risk. It's going to be very localized. We have some Mexican economic data, which I think is interesting in the guise of trade wars, and some others. But I don't really think anything will rise to the scale of exceptional volatility, much less market movement across the world. Tuesday, very interesting. We have the RBA, which is expected to cut by 25 basis points. I'm going to be watching that one for the APAC region. In the US, I'm going to be watching US CPI. Obviously, if the president has concerns about non-farm payrolls, he definitely has concerns about inflation. He stated them many times before. That indicator, if it comes across the wires and it's higher than expected, is definitely going to charge his concerns and prompt some responses from him. Now, the CPI is actually a different reading or a different group than what we had from the labor data. So that's going to be an interesting consideration. And then we also have the expiration of the US-China 90-day delay on their very extensive tariffs. Not a lot of conversation has been going on in terms of progress between those two countries, but that is going to be a big one. The markets don't seem to be putting a lot of emphasis into it, and we haven't really seen major headlines around it. So maybe the markets are playing it down, or maybe they just are being blasé and ambivalent to it, and they could be shocked into a response. Now, Wednesday, also very low level event risk. There's interspersed throughout the day, notables, but nothing that would rise above the regionality. Thursday, we get back into the final stretch of 48 hours of event risk. We have UK GDP, and later into the Tokyo session, Friday early morning, the Japanese GDP figures. Definitely watch those. US PPI, that's the factory level inflation indicator. Depending on how the US CPI goes, this could have more or less impact on the market's interest in a thematic way. And then into Friday, we have a run of July Chinese data. In particular, we have local growth consideration, obviously the consumer, retail sales, employment. We also have fixed asset investments, fixed direct investment. But I'm going to be watching industrial production. Manufacturing is still key in China, and that's the indicator that I watch a little bit more closely. And into the U.S. session, U.S. retail sales. And very important, I think this is going to have a little bit more of a forward-looking consideration, is the University of Michigan Consumer Confidence Report. That's probably going to be one of the top events for the week for me. Funny enough, it comes at the twilight of liquidity. All right, that wraps up the week ahead. Don't forget to like and subscribe for more financial news.